Welcome back to the Retire in BC podcast. Today we're tackling one of the most common and one of the most emotionally charged questions that we get. Is now a good time to invest or should I wait? We've all seen headlines of just full of tariffs, threats, wars, elections, looming recession. There's lots of reasons to feel uneasy. It's reasonable to feel uneasy. In this episode, we're going to explore what I would consider the timeless debate of market timing versus time in the market. Uh, you may have heard the phrase. It's not market timing, or it's not about timing the market. It's about time in the market. Anyhow, there you go. I got it right.
That's the one. There you go.
And why that distinction can make or break your retirement plan. Ben, what's your take on recent events?
Yeah, well, it certainly feels to me like in the past few years, and I use few years a little bit liberally here. It feels to me like we had a pretty great run up from 2009-ish. We had a decade of pretty good returns, just about. And then kind of starting in 2018, that was a negative year with well, sort of topically here with Trump and his tariffs and his trade war with China. That kicked a lot of that off. But certainly since 2018, it's felt a lot more like markets have been choppy. Every other year, it feels like we're getting something negative with 2018, the aforementioned tariffs, 2020, the coronavirus, 2022, interest rates. And then now again this year, we had some choppy markets at the beginning of the year. That it definitely feels like, things are wavy and choppy and up and down. But I think some of what we're trying to get at in today's episode is that it's really normal to feel that way. That's almost the natural state of things, almost the natural state of humanity, is to look at the negatives and, what's coming next and how do I prepare for it? And after you've been through it and you look back at the last 5 years, the last 10 years, you realize, you know what, actually, we navigated that pretty okay. Markets are way, way up since the beginning of that. And so, yeah, what we're trying to do is just kind of, guide people through those feelings.
Well, actually, this might be a great point to highlight what's normal in the market. And frankly, I've been talking to my clients about this a lot this last 6 months. What's really, really normal in the market is to see what's called a correction every year or two. And a correction is defined as a drop of 10%. Historically, that's happened about every year or two. It'll drop by 10% and then it'll go back up. And what's also normal historically is on average every 5 years to actually have a bear market where it drops by 20% or more. And usually it doesn't stop at 20, it usually is or more. But these are very, very normal events. Again, they drop, we have the bear market, and then they come back up. But it can get hard to take, and especially when we see a lot more headline news, which we're definitely seeing right now. And maybe later on in the podcast, I'll talk a little bit about how I think things might be a little bit different for the next little while. But people should be forgiven for feeling anxious because there's lots of reasons to feel anxious.
Yeah, well, and that kind of comes down to two things too in my mind that make that more prevalent and make it harder to just relax and let things be. One is that oftentimes, we talked about this last episode, but it's the media. You turn on the news and they're broadcasting all of the negative things that are happening.
Financial pornography.
Yeah, exactly. Biggest drop in such and such a market in such and such a time frame. Oh, woe is us. Everything's going to be terrible. So that's one aspect. And the other is it's always going to feel like this time it's different. This time it's the coronavirus. We've never had a pandemic of this scale. We've never had the world shutting down like it did. Or, this time we're coming off of a 40-year cycle of interest rates and we've just hit the bottom and now they're going up again or whatever. And in some aspect, that's true. It is a different scenario each and every time. It's not as though we're going through the exact same scenario, but long term, sort of the macro factors at play mean that, we believe that in the next 10, 20, 50 years, businesses are going to continue to grow and scale and be more profitable, and that therefore there's a positive long-term horizon. In that, it's not different. It should turn around. We'll talk about that in a bit too,
Well,
the
every
longer
every
term.
time it's different, and every
Exactly.
time it's the same.
Yeah.
It is what it is. Yeah, no, it's when you've been through it a bunch of times, and certainly I have been through many bear markets. So the bigger declines, and in fact, actually a couple of even worse than bear markets, things that happen once in a generation. And even for me, frankly, when they happen, I don't like it. But most of the time, I'm kind of immune to it because I've seen it so many times. The really big ones, even those, sometimes I end up feeling a little bit like, oh, is this different? And then I have to go back, do some research, and look at history and realize that, no, you know what, this kind of thing has happened before. And
Yeah.
it's human nature. We get through it.
Yeah, well, and so that's it, right? Is that it is scary. It's scary to watch your invested dollars dropping while something bad is happening in the global, market, and you don't know when it's going to end. And so, one of the things, one of the tools that we like to look at when that happens, is basically you put a chart long term of the stock market up there, and you list all of the negative things that have happened
Yeah.
along it. World wars, the Vietnam War, 9/11, China, the stock market selling off, like all sorts of these things. And on a longer time horizon, when you look at that, the market continues just trending up through each and every one of those. And so I like to just position it as, let's zoom out just a little bit. We are here, and Trump has announced some tariffs. Uh, 10 years from now, do you think we're going to be able to pinpoint Trump's tariffs on
Yeah.
that chart? I don't think so.
Yeah. Yeah.
Maybe we will, but it would have been some other confluence of factors, right? Like we're not saying that we're not going to experience that short-term bear market.
Yeah.
We very well may, but what we're trying to do is construct your portfolio or our clients' portfolios in a way that when that happens, they're still comfortable riding it out.
A great analogy, and maybe I've used this before, I don't know, but I'd like to think of a person climbing a mountain with a yo-yo, and the tariffs are the yo-yo. There's this general uptrend, but while we're going on the uptrend, there are these ups and downs. If you focus on the yo-yo, you're going to get really scared. If you zoom back, like you just said, and look at the bigger picture, well, there's this constant positive trend. And frankly, and again, I'm going to touch on this a little bit later, but I actually think we have a much bigger positive trend than we have in the past, looking forward in the next 10, 20, 30, frankly, 40 or 50 years. I'm not going to be around that long. I wish I was, because I think things are headed in a phenomenal direction. But we'll talk about that another time. Yeah, I mean, I don't know about you, Ben, but once in a while I get a phone call and people say things are nerve-wracking. Should I cash out? Right?
Yeah, well, and that's what I think we're getting at here is that's exactly the question we want to address is putting yourself in the shoes of the client. The client comes and they say, I have a feeling about the market and I want to cash my money out. Effectively, what you're saying is that you know better than the market. Um, because we have to remember the market is forward looking. And so if you have a bad feeling, so does everybody else, and they've already sold, and you're probably too late. Um, and it's this big behemoth. It's billions of participants. It's trillions and trillions and trillions of dollars, and all of that collective wisdom feeds into the prices of stocks and the market today. And so exactly, it's a little bit of hubris to say that you know better, and maybe you do, maybe you don't. But yeah,
You, you
that's
know, every time or often people will come to me and say so and so says markets are going to crash, right? Some talking head on the news. And I like to remind people that, you know what, every time we've had a crash, somebody has called it. Somebody has said there's going to be a crash. The problem is it's never the same person. So yeah, you've got all these talking heads. Some of them are going to be right. Dumb luck.
Yeah.
Or maybe they're smart and they get it, but they only get it once. So if you focus on that, you'll miss out on all the ups.
I think reframing it is helpful too, in that right now you're trying to protect your portfolio by selling it before it drops. You're trying to protect from a downturn. But on the flip side, if you sell at the wrong term at the wrong time and then the market shoots up, there's an opportunity cost. And so we as humans, we fear the negative more than we like
Yeah,
the potential of the positive.
twice as much, I
But
think.
I think more. I think it's like 3 or 4 times as
Yeah.
much. Um, but in terms of a portfolio and in terms of numbers, they're equal. And so that's something that, let's say you had sat out after the flash crash of COVID and you sold everything in April or whenever it was, you would have missed out on one of the fastest recoveries ever. And then you're not really, eventually you'll get that money back, but you really did miss out on a great buying opportunity. And we just never know when the bottom is. We don't know when the top is. We don't know when the bottom is. Just putting that straight out there. But the tricky part too is that a lot of the best trading days and a lot of the worst trading days kind of happen back to back. So there's a stat that often gets sort of thrown around that if you if over a long period, even like 10 or 20 years, if you miss the 10 best trading days within that period, it has a massive impact on your return over the whole period. Like it missing the 10 best days cuts it almost in half over that period. I don't always love that stat because, like I said, those days often happen right next to the really bad ones, but it is just something to think about.
Well, frankly, it's going to be worse when we look back in a couple of years because just when you look at this year, due to the tariff announcements, the volatility that we saw day to day on a positive and a negative basis was insane. It was, I think, among the most volatile day to day that I've ever seen. Maybe not the most, but almost. It was pretty wild. So yeah, no, to Ben's point, the only way to be in for every day of the ups is to be in for every day of the downs. And the best thing that you can do is build a portfolio you can live with, knowing it's going to go down sometimes, but that you can live with that and stick with it, stick through.
Yeah, well, and that's it too, is that I think, again, we highlighted this, we did a whole episode on it on risk versus reward, but it's just trying to hammer home that volatility isn't a bug, it's not an error, it's the price of admission. It's you are literally being compensated for taking on that volatility with expected higher growth. And so the cost of a higher growth portfolio is more volatility. Learn to live with that, or not, or we do shift your portfolio if you can't handle the volatility. But trying to day by day or week by week get in and out at exactly the right time, more or less a loser's game. Um, you know that's not likely to work out in your favor.
Yeah, no, no, I agree. Better like don't wish for less volatility because the implication of that is lower returns.
Yeah, yeah.
Yeah,
And
yeah.
so on that note, we've had some examples of this happening of clients asking to or talking about pulling their money out. It's, things look choppy. Should I pull it out? We've usually managed to talk them down and had exactly this conversation that, what, eventually it'll turn around. We don't know when. Now's maybe a good buying opportunity, maybe not. Depends on really the client's cash flow in that case. And for the most part, clients have taken our advice and been very, very happy that they've done so.
Yeah, yeah. I used to have a little bit of to me, it was a canary in a coal mine kind of thing. If I had more than a couple of clients that I couldn't talk out of getting out of the market, it was a sign to me that it was the best buying opportunity that existed. And historically, that's actually kind of true. We haven't really, I haven't had many people need to cash out for quite some time, but or that worried about it. But yeah, usually that's an indicator that it is the best possible time to be buying, not the other way around.
Yeah, well, and like think about what happens if you do pull your money out and then things turn around. Like think about the market is down
Right.
20% and I cash out. And now the market has recovered, but whatever bad thing shocked the market is still ongoing. Are you now going to redeploy your money, or are you still going to feel like the market was overpriced before the recovery and now it's just even more overpriced? Uh-oh. And so waiting on the sidelines, sometimes you're just waiting forever, and it's not really a good position to be in. So um so we kind of chatted about this too, in that predicting markets short term next to impossible. I kind of ease up on that a little bit in the long term.
Right.
It is possible to look at a market and say, this economy looks healthier than that economy. At over 20, 50 years, I think this one will do better. So yeah, I think you had some thoughts on the long-term outlook here. Do you maybe want to dive into that?
Yeah, sure. I mean, well, we sort of headlined this section is now a good time to invest, right? And my short answer is pretty much always yes. The um, the odds, even though it's just randomly, never mind the time period that we're in right now, the odds randomly are a 75% chance that your investments will be higher a year from today, but a 25% chance that they might be lower. But still, that's a pretty favorable bet, right? 75-25. Um, when we've just had a hit, those numbers get even, when we've just had a hit in the markets, those numbers get even better. Um, but in my opinion, right now, today, I think we are in one of the single best time periods that I have seen maybe in my career. I believe over the course of the next 10, 20, 30, 40, even 50 years, we are in one of the best times for investors that ever existed. If any of you are interested in reading about economic stuff, this is it's not super heavy reading, but it's not light reading either. Steve Poloz, he's the guy that took over for Mark Carney when Mark Carney left the Bank of Canada to go over to England. Steve Poloz is the guy that took over, and Poloz, and he wrote a book called The Next Age of Uncertainty. It's actually a very good book to read. One of and it's not all positive. It's not all Pollyannic thinking. But one of the key elements that he highlights, and I 100% agree with this. In fact, he got me. I'd been thinking more about AI. He talked more about the digitalization of businesses, but the one of the key components of that book is, in his opinion, and I agree with him, we are in the next industrial revolution. There is this thing going on with businesses and them digitalizing, them utilizing technologies, just like Ben and I are here right now, like we do with our clients meeting online, utilizing artificial intelligence, utilizing various technologies that are letting us do more in the cloud. Those things are making businesses more profitable. And that's it's a very long-term positive trend. And when businesses are more profitable, you and I as investors, we benefit more. So we've got this long, big industrial revolution trend that's pushing markets forward. That doesn't mean every year is going to be positive, unfortunately. Well, no, fortunately, because like Ben said, you make more during volatility. But the rather than having headwinds, we've got wind on our back, pushing us into this great environment. On top of that, I do think the next few years, and this is just a thing with Trump, are going to bring greater short-term volatility. Those corrections that I talked about earlier, the historically they've happened every year or two. In my opinion, they happen once or twice a year for the next few years, because a year from now we are going to have forgotten about tariffs, but Trump's going to say something else and it's going to freak us out and markets are going to go down. So I'm expecting greater small levels of volatility, correction level volatility, for a number of years. But I'm also expecting a much more positive environment for decades, and particularly for the next decade.
Yeah, well, tariffs are one aspect of it. One other thing that I think kind of influenced us to talk about this as well is that it's not just about Trump and the US and tariffs. It's also about right now we are seemingly going through a period of heightened global tension, global war, and things like that. Um, that also could continue on into the next few years,
For
could
sure.
spell out into some bigger conflicts, could contribute to more of this volatility. So I'd agree, kind of those two factors combined mean that, again, we don't know when the recession is going to happen, the correction. But I agree. I think we're going to see, continued volatility here. I do want to circle back to one other thing. I mean, you had talked about when is a good time to invest, and you said always, more or less. Um, I agree, but it also comes back to the client. What's their time horizon? So is it a good time to invest? It is if you have a long time horizon, and
Good
it is
point.
if
Yeah.
your financial plan says that you need the growth. If you're in a position where you don't need to invest and you can just live off your cash, you wouldn't need to do it in the first place. But for most people, they like to grow their assets over time, even if they are in that position. So that's just one thing there. The other thing I want to look at is what if what if you're wrong, or rather, what if you're right and you make the wrong decision? I'll put that in air quotes, the wrong decision to invest at a bad time. Uh, and one thought experiment that I really like to highlight is the story of Bob, the world's worst market timer. I didn't come up with this. It was written by Ben Carlson for A Wealth of Common Sense. I'd recommend go Google that, read up on Bob, the world's worst market timer. It is a great little read, just like a short, 2-page thing. But it's about Bob, and he starts saving 2 grand per year, and he just sits it in his bank account for a while. He's not brave enough to invest until the market is at an all-time high. There's just been a huge run up in the markets, and finally he decides to deploy his capital. And then immediately after he deploys it, the market tanks, right? And then he does it again and again and again. Each decade, he bumps up his savings by 2 grand per year. And so what that looks like is this goes back like quite a few years. I believe he starts in the 60s or something. This is a historical simulation. In December of 1972 is when he puts his first deployment of capital in, right after the market falls by 48%. This is all in US markets. Then he saves up and saves up and saves up and deploys more money in 1987. Right after he does that, the market tanks 34%. Then he saves up till 1999. Right after he invests, the market crashes by 49%. And then again in 07, he deploys more money and the market crashes 52% again. Bob's saving grace is that even after all of those terrible crashes, when he's just invested all his money and things have tanked, he doesn't pull it out. He leaves it invested for the long term. And so, despite being the world's worst market timer, he has invested in total 184,000. And at the end of his, I think it's a 40 or 45-year time horizon, he ends up being a millionaire. He has like 1.1 million in the bank. And so I just like to share that story as a example of, what, even if you make quote unquote the wrong decision and invest your money and the market tanks, if you have a long enough time horizon, you're going to be okay.
Well, and Ben, actually, that really reminds me of a strategy that I know I've used not tons, but a number of times. When clients are coming in with a large sum of money, this isn't something I recommend. If you already have $1 million invested and you're coming to add an extra 50 or even 100,000, I wouldn't recommend this. But if you have 100,000 invested and you're coming to invest 1 million, well, it's something you might want to consider if you're nervous. Again, remember I said, the odds are 75%. that just in a random environment, the odds are 75% that your investments will be up in a year. So you probably are best off investing that full million on day one. But if you're really nervous about that, or sometimes if we're nervous because markets have been on a great big run, we might say, hey, you know what? Let's, give me the $1 million, but we're going to put it in something ultra safe, a high interest savings fund or something like that that won't earn much, but won't go down, or maybe something that won't go up or down much either. And then we're going to slowly shift it bit by bit over the course of 6 months or a year or even 2 years, and just every single month or every single week. We can set it up however you want it set up or however we think it's best. We just have it shifted into the more aggressive where we think you should be long term. And that takes some of that risk out of it and just gets you in bit by bit by bit. And it can be an easier way to handle it. Again, it's not my first go-to, but if somebody's in that boat where they're nervous about things, that can be a great way to go because then you're just taking the risk away of hitting that one worst possible day, where the next day you see this big crash.
Yeah, no, I really like doing that too. The dollar cost averaging is a great way to do it. I almost would say, it's not a go-to for me either, but like it is up there in terms of totally viable strategies to try to reduce some of the risk. Because so much of our job is trying to make sure that clients are comfortable with the ups and downs. And this is a great way for, not very much cost. There's a little bit of opportunity cost, but to tame some of that risk. So for me, that's kind of if you're sitting on a pile of cash that's more than like 2 or 3 years worth of savings for you, or if it's like 25% or 50% of your total investment capital or total net worth, yeah, you might not want to do what Bob did and put it in and then right then have a crash, right away. If you drip it in over the next year or two, you do mitigate a lot of that risk.
I think the other thing that's really valuable for our listeners to know is we know that volatility is going to happen. It's not a if, it's a when. It's every day, and sometimes it's worse than others. And so and not just us, most advisors, all good advisors know volatility happens and build portfolios knowing that that's going to happen and build portfolios to try to take advantage of that volatility.
Yeah, yeah, for sure. And a lot of that, it's done through diversification. If you're more interested in that, I go check one of our prior episodes on building a resilient portfolio.
Yeah, yeah.
We get into that a little bit more. But exactly, the goal isn't to totally avoid volatility altogether. Again, it's the price of admission for a high growth portfolio. It's to get through the volatility, not panic, stick to your plan, and yeah, reach your long-term goals. So yeah, I mean the practical takeaways here are check out, what your plan is doing over the long term, not the headlines. The question is, are we still on track for the goals that we had set out to begin with? So, is your portfolio still aligned with your time horizon? Are you still comfortable sleeping at night with the volatility? So we're not trying to say no one should ever avoid volatility by making their portfolios more conservative. A lot of the time that should happen, but it shouldn't be in response to, or it shouldn't be purely in response to current volatility happening. It should be a broader discussion about, it have the goals changed, or sometimes people think they can handle more volatility than they actually can. When it appears, they say, oh, you know what, actually, I didn't like that ride very much. Is there anything we can do to reduce the volatility, knowing that it will also reduce the return,
You know,
or the long-term expected return?
that's actually a really great point, Ben. Again, over the last 6 months, I have really spent quite a bit of time talking to every single client about, hey, you've seen this volatility, especially, during the few months here earlier in the year when the tariff talks all of a sudden caused this crazy volatility. Are you sleeping at night with that? Should we make your portfolio more conservative? Very few said, I want to make it more conservative. But I did have a couple that did. And in those cases, we looked at it. In one case, we did it right away. In another case, I said, you know what, you'd be better off if we just wait for things to recover a little bit and then we'll do it then. And that's exactly what we did. There's nothing wrong with that. There's nothing wrong with recognizing that, you know what, I was wrong about how I thought I felt about volatility and making the portfolio what lets you sleep at night with, right? That's
Yeah.
what we're here for. So,
Well, and
yeah.
changing circumstances, right?
Yes,
It's,
yeah,
oh, you know what, the goal of the house purchase that was 10 years away, and now it's 7 years away. How do I feel about that? Should we change the risk in the portfolio? Very valid questions to be having. And so we're just trying to say, don't be too reactive that just because volatility has shown up now in the markets, that in and of itself shouldn't really be dictating too much what you're doing in the portfolio.
that's
So,
right. That's right. Yeah.
so yeah, sorry, go ahead.
No, just yeah, I was just gonna say, I mean, the antidote to fear isn't guessing the future. It's having a plan that doesn't require you to.
Yeah, yeah, definitely. Definitely. So, yeah, that more or less does it. We had opened up with that saying that I'll repeat again now. Time in the market beats trying to time the market every time. So, yeah, if you've been wondering if now is a good time to invest for you, or if you're worried about your own portfolio and want to chat about what to do about it, feel free to give us a shout. We'd love to chat with you. Or if you have any questions for us to address in a future podcast episode, send them in as well. We might feature them. Thank you so much for listening to the Retire in BC podcast, and we'll see you next time.
Thank you.
Bye. The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.